Assumes the Fed sets mortgage rates. And for the last decade, that's been mostly true, but not right now. Right now, your mortgage rate is being set by oil traders reacting to Middle East headlines. Let me show you exactly why that's happening and what it means for interest rates and your rate lock decision. Quick foundation. Your mortgage rate doesn't come from the Fed. It comes from mortgage-backed securities, known as MBS. These are investments backed by pools of mortgages that trade on the open market. When MBS prices go up, your interest rates go down. When MBS prices go down, your rate goes up. Pretty simple stuff. Now, MBS trades in relation to the 10-year Treasury bonds. There's normally a spread between them, usually somewhere between 1.6 and 2.5% in a normal market. When the Fed does quantitative easing, QE, they compress that spread by buying more MBS. That's what happened during 2020 and COVID. Fed bought billions in MBS, rates dropped to historic lows, and a lot of you refinanced because of that. When the Fed tapers or tightens, called QT, the spread widens back out. The Fed has real influence on the MBS market. Keep that in mind. The Fed still matters, but the Fed isn't all that matters. And right now, something else is doing more of the driving. For the past decade or so, the traditional drivers of MBS were pretty consistent. Number one, depending upon the moment, they were the monthly jobs report, specifically non-farm payrolls, and the CPI inflation report. These two are basically interchangeable in importance. Both feed Fed policy expectations. Strong jobs, hot inflation, equals Fed likely hikes. MBS sells off, weak jobs, cool inflation, Fed eases, MBS rallies. GDP used to carry more weight. Doesn't so much now unless we're heading into or out of a recession. Then it becomes an indicator of when Fed policy could shift. This traditional framework is still valid. Jobs and CPI still move markets, but something got layered on top of it. And that layer is now doing more moving than the traditional drivers on a lot of days. Geopolitics has always mattered to markets to some degree. Brexit, wars we're not directly involved in, trade tariffs, but something changed in the last year or so. Geopolitical events with real inflation implications are now a primary market mover on a lot of days, not the Fed. Here's the important nuance though. Not all geopolitics moves the markets. The market is actually pretty good at separating real risk from noise. Major tariffs are a real issue when they get implemented, but continued threats of tariffs that really don't materialize, the market has started treating that as a little bit of background noise. What does move the market right now? US and Iran tensions, specifically because of oil. Let me walk you through the chain, step by step, because most people miss this. Step one, Middle East tensions escalate. Step two, oil prices spike. Step three, higher oil prices mean higher gas prices, higher shipping costs, higher energy costs across the board. Step four, that shows up in inflation data a few months later. Step five, pricing in the Fed keeping rates higher for longer to fight that inflation. Step six, MBS sell off on those rate hike expectations. That's why on Monday, July 13th, to give you an example, when the announcement came about a strait blockade and tariffs on ships going through the strait, oil jumped by 9.5% in a single day. Biggest oil move in 2.5 months. And MBS lost 46 basis points that same day on a Monday with zero economic data. It was all that oil inflation and geopolitical chain playing out. So, now you might have heard about the flight to safety. That's when investors get scared and move money into treasuries and bonds. And it's a real thing. When a bad jobs report comes out or the economy shows real weakness, investors pull from stocks and park in the treasuries and bonds. In that scenario, MBS benefits along with treasuries. But that's not what we're seeing now. What we're seeing now is inflation-driven fear, where on some days, money leaves both sides, stocks and bonds, because inflation hurts everything. That's why MBS is getting hit. Okay, So what do you actually do with this information? Here's my honest framework for what I'm telling clients right now. Number one, watch oil prices, not obsessively, but stay aware. The correlation between oil and MBS is very dialed in right now. When oil moves up on Middle East news, rates trend up. When oil eases on de-escalation, rates get some breathing room. That correlation could break if oil returns to pre-war levels or if the situation stabilizes. Until then, oil is your leading indicator. Number two, on rate locks in a stable environment, I generally prefer to lock quickly. Get certainty, move on. In this environment, I'm still leaning pro-lock. There's too much headline risk to gamble on waiting. There is one exception, however. If we're near recent low levels and I see room for a bit of correction or bounce, I might advise waiting a few days. But that's a judgment call I make and we make together based on where we're at in the cycle. Most of the time in this environment, lock the rate you have. Don't gamble on the news. And number three, honestly, a lot of my clients just want me to deal with this. They don't want to watch oil prices. They don't want to track the headlines. They tell me to lock it when it makes sense, and I do. And that's totally fine because there's just a lot of information out there, and my job is to narrow it down for you. That's what a good broker does. Markets don't like uncertainty, and uncertainty usually equates to higher interest rates. That's where we are at right now. If you want someone watching this stuff for you and telling you when to move, head to johncobainhomeloans.com. I'll walk you through what your specific situation looks like. No pressure, no pitch. If this was useful, please hit subscribe. Every week, midweek, I break down something like this. Every Saturday, I recap the market for that week. I'm John Cobain, mortgage broker with Edge Home Finance, NMLS 374881, 30 years helping Washington homeowners. See you in the next one.